In the world of corporate finance, a hostile takeover happens when one company attempts to acquire another against the wishes of its management. The term sounds aggressive because it describes a scenario where the target company board rejects the offer, but the acquirer persists anyway. To succeed, the buyer usually needs to control over 50% of the voting shares, giving them the power to change company policy. The buyer might bypass the board by appealing directly to shareholders, offering them a higher price for their stock than the current market value. Unlike friendly mergers where both companies agree on the benefits, a hostile takeover is a conflict between the buyer and the target's leadership. If the premium offered is high enough, shareholders might choose to sell their stake to the acquirer, effectively forcing the deal through. Ultimately, these events serve as a reality check for management teams who may not be delivering the returns that investors expect. Understanding corporate power struggles helps you see how markets function beyond just daily stock prices. Like and subscribe for more finance basics.